For 50 years, a single system has dominated the way money moves between countries. This system is called SWIFT. It was founded in the 1970s to standardize how banks communicate about international transfers. It was a revolutionary idea at the time. It created a common language for global finance. But SWIFT does not actually move money. It sends secure messages between financial institutions. It tells Bank A to credit Bank B. The actual settlement of funds happens through a complex web of correspondent banks. This process has remained largely unchanged for decades, creating a significant gap between our digital world and our financial plumbing. The core problem is one of architecture. To send money from the United States to Thailand, a bank in the US might not have a direct relationship with the Thai bank. So, the payment message hops between several intermediary banks. Each bank in this chain takes a fee. Each one adds time to the process. The funds must move through a series of accounts that banks hold with each other, known as Nostro and Nostro accounts. This system was built for a world of telex machines and paper ledgers. It was not designed for the internet age, where information and value are expected to move instantly. This legacy system creates a fundamental disconnect. We can send an email to the other side of the world in a fraction of a second. We can stream a high-definition movie from a server thousands of miles away without a buffer. Yet, sending money to a family member or a business partner abroad still takes 3 to 5 business days. This delay is not just an inconvenience. It represents a massive inefficiency baked into the global economy. It is a system operating at the speed of the 20th century, while the rest of the world has moved on to the 21st. The stark contrast between 3 to 5 days and 3 to 5 seconds defines the challenge. The user experience reflects this outdated process. Senders often face high, opaque fees. They are never quite sure how much money will arrive at the destination after all the intermediary banks take their cut. Tracking a payment can be nearly impossible. The friction in cross-border payments is not just an annoyance, carries a staggering economic cost. Industry analysts estimate the inefficiencies cost the global economy around $120 billion each year. This figure represents a combination of direct fees, currency conversion, spreads, operational costs banks incur to manage this complex process. It is a hidden tax on global trade remittances and investment. This money is not creating value. It is simply lost to the friction of a slow and outdated system. Every dollar spent navigating the maze of correspondent banking is a dollar that could have been invested in a business or used to support a family. A significant portion of this cost comes from trapped liquidity. To facilitate international payments, banks must hold funds in accounts all over the world. These are the pre-funded Nostro accounts. Collectively, trillions of dollars sit idle in these accounts, acting as a financial buffer. This is capital that cannot be used for lending, investing, other productive purposes. It is dead money, locked up just to make the old system work. In response to these challenges, a new model for global payments has emerged. Ripple, a San Francisco-based technology company, has built a decentralized financial network called RippleNet. The network connects banks, payment providers, and digital asset exchanges, allowing them to send money globally in a faster and more cost-effective way. Unlike SWIFT, which only sends messages, RippleNet is designed to settle the actual transfer of value. At the heart of Ripple's solution for on-demand liquidity is a digital asset called XRP. It was designed specifically for payments, with a focus on speed, scalability, and low cost. XRP acts as a neutral bridge currency. This allows financial institutions to move value between two different fiat currencies without needing to hold those currencies directly. Ripple refers to this solution as on-demand liquidity, ODL. It's a different way of doing things. The potential of this new technology is best understood through real-world examples. Southeast Asia has become a key testing ground. The region is a dynamic hub of commerce and remittances, but its fragmented financial landscape makes cross-border payments hard. In 2021, Ripple bought a 40% stake in Tranglo, a major cross-border processor based in Malaysia. Tranglo serves a wide corridor: Philippines, Indonesia, Singapore. The partnership integrated Ripple's on-demand liquidity, ODL, into Tranglo's network. The results have been striking. Before ODL, Tranglo's legacy rails were significant but limited. After ODL, processed volumes surged. Payments that once took days and required costly pre-funding could now settle in seconds. That let Tranglo offer partners faster, cheaper remittances, including Filipino fintech iRemit. For millions of Filipinos abroad, families got money faster, with lower fees. Corridors that took days can now finish in under a minute. It's a tangible feature of daily financial services, improving lives and enabling commerce. Well, that's the change we're seeing. The impact of Ripple's technology is also becoming visible in Africa. Cross-border payments have historically been slow. Cross-border payments have historically been expensive. Cross-border payments have historically been unreliable. In 2022, Ripple announced a major partnership with Onafrique. Onafrique is one of Africa's largest mobile money networks. This connected Onafrique's footprint across 27 countries to RippleNet. Initial focus: remittance corridors from the Gulf region. Australia, the United Kingdom, workers could send money home to Rwanda, Uganda, Tanzania. But sending money to the continent often involved some of the highest fees, and delays stretching for a week or more. The Ripple-Onafrique partnership directly addresses this. Payment providers can now offer funds that arrive in under a minute, instead of in a week. This speed and reliability are transformative. Families receive money when they need it most, without losing a significant portion to fees and intermediaries. Similarly, in the Middle East, institutions are adopting Ripple's tech. The Saudi British bank, SABB, an affiliate of HSBC, began using RippleNet to power payments to India, later expanded to Sri Lanka and the Philippines. Understanding how Ripple achieves this speed requires looking at the technical flow, which is remarkably simple compared to the traditional system. The entire process is designed to eliminate intermediaries and the need for pre-funded accounts. Imagine a bank in the United States needs to send $1,000 to a recipient in Mexico. Instead of routing the payment through multiple correspondent banks, the bank can use RippleNet's on-demand liquidity. The process unfolds in a few straightforward steps, turning a multi-day affair into a transaction that completes in seconds. Here is how it works. First, the sending institution, Bank A, initiates the payment on RippleNet. The network is instructed to deliver $1,000 worth of value to the destination. This is the start of the transaction, but instead of sending a message that needs to be settled later, the network begins the settlement process immediately. This is a fundamental difference from the SWIFT model, where messaging and settlement are two separate, time-consuming events. Second, the network instantly converts the US dollars into the digital asset XRP. This happens on a digital asset exchange that is connected to RippleNet. The conversion uses the current market price, sourcing liquidity from the exchange's order book. This step effectively turns the fiat currency into a highly portable digital asset that can move across borders without friction. Third, the XRP is sent across the XRP ledger from an account controlled by the sending institution's liquidity partner to one controlled by the receiving institution's partner. The XRP ledger is a decentralized network that confirms transactions in 3 to 5 seconds. It is incredibly efficient, processing thousands of transactions per second for a cost of less than a penny. This step is where the time savings are most dramatic. What used to take days of bank-to-bank settlement now happens in the time it takes to refresh a web page. Finally, once the XRP arrives, the network immediately converts it back into the destination currency, in this case, Mexican pesos. This happens on a partner exchange in Mexico. The pesos are then deposited into the account of the receiving institution, Bank B, which credits the final recipient. The entire end-to-end journey, from dollars to XRP to pesos, is completed in under a minute. Dollars, XRP, pesos, no nostro accounts were needed. No intermediary banks took a cut. The payment was settled instantly, with full transparency and at a very low cost. For financial institutions, this means lower operational costs, reduced counterparty risk, and the ability to offer faster, cheaper services to their customers. It represents a shift from a system based on correspondent relationships to one based on interoperable technology. Instead, value is transferred directly and instantly over a modern digital rail. When comparing SWIFT and Ripple, they were designed to solve different problems in different technological eras. SWIFT was created to standardize communication. Ripple was created to enable instant settlement. This fundamental difference in purpose leads to vastly different outcomes for users. A side-by-side comparison reveals why new digital rails are gaining traction. The primary distinction lies in what each system actually does. SWIFT moves information about money. Ripple moves the money itself. Let's start with speed and cost. A typical SWIFT transfer takes 3 to 5 business days to settle. Payments pass through a chain of correspondent banks, each with its own processing times and cutoffs. In contrast, a payment settled with XRP on RippleNet takes 3 to 5 seconds. The fees are worlds apart. A SWIFT transfer can cost $20 to $50, often with intermediary deductions. An XRP transaction costs a fraction of a cent. With SWIFT, tracking a payment can be difficult. RippleNet provides end-to-end visibility. Sender and receiver see status in real time. While cross-border payments are Ripple's primary focus today, the company's ambitions extend much further. The technology it has built is not just for moving money, it is for moving any form of tokenized value. This positions Ripple to play a role in several emerging areas of finance. Central bank digital currencies, asset tokenization, integrated treasury management. The payment network is just the first layer. The ultimate vision is a global financial system where all forms of value are interoperable and can be exchanged instantly. One of the most significant areas of development is central bank digital currencies. Central banks around the world are exploring the creation of digital versions of their national currencies. Ripple has built a dedicated CBDC platform to help these institutions mint, manage, and transact with CBDCs. The platform is already being used in pilot projects with several countries, including Bhutan, Palau, Montenegro. These pilots are testing how a CBDC can be used for retail payments, cross-border transfers, other applications. Ripple's platform provides a neutral ground where different CBDCs could potentially be exchanged, solving the critical problem of interoperability. Asset tokenization is another major frontier. This is the process of creating a digital representation of a real-world asset, like real estate, art, a private company's stock, on a blockchain. Once tokenized, these assets can be traded and settled instantly, 24/7. This could unlock trillions of dollars in illiquid assets, making markets more efficient and accessible. Ripple's technology, including the XRP ledger, is well suited for this purpose. The company is actively working with partners to build out the infrastructure for tokenizing and trading a wide range of assets, moving beyond payments into the broader world of capital markets. These broader applications are all connected. A world with CBDCs and tokenized assets will need a way to move this new form of value across borders efficiently. A network that can settle a cross-currency payment in seconds can also settle a trade for a tokenized security in seconds. This is where Ripple's early work in payments gives it a strategic advantage. It is already building the rails, relationships, and liquidity. The global financial system is on the cusp of a major transformation, moving from analog-era plumbing to digital native rails. Ripple is one of the key companies building this infrastructure. Its focus is solving cross-border payments, giving it a practical foothold. The core value proposition is simple and powerful: faster movement of money, cheaper movement of money, more transparent movement of money. This has attracted a growing network of banks, payment providers, especially in emerging markets. Shift from a 3 to 5 day settlement cycle to a 3 to 5 second settlement cycle, not just an incremental improvement, a paradigm shift. The power of the model is the network effect. Financial institutions join RippleNet. Corridors go live with on-demand liquidity. More partners create deeper liquidity. Deeper liquidity lowers costs. Deeper liquidity improves service quality. More payment traffic moving onto these new rails leads toward a tipping point where the new model becomes default. Signals to watch for: announcements of new payment corridors in remittance and trade markets across Asia, Africa, Latin America, mentions of RippleNet integration and on-demand liquidity in quarterly reports and official filings, progress of CBDC pilots like Montenegro and Palau, and major institutions publicly discussing using XRP in treasury and liquidity strategies. When these signs become frequent, the new rails move from fringe to mainstream. In short, the future of global payments is being built. Now watch adoption of faster, more efficient digital rails, one corridor at a time. SWIFT's system relies on messaging. It tells banks what to do. Ripple's system executes the transaction itself. That's the difference between sending a letter and pressing send on an email. And the efficiency gap is massive. 3-5 days versus 3 to 5 seconds. $30 in fees versus fractions of a cent. Opaque status versus real-time tracking. That's why more than 40% of Ripple's partners now use XRP for settlement, because cost efficiency is a language everyone speaks. But here's the twist: SWIFT isn't disappearing, it's adapting. They've started experimenting with blockchain interoperability and tokenized settlement. But Ripple is already years ahead, with live corridors, regulatory clarity, and proven throughput. Asia, Africa, Latin America, they're not upgrading SWIFT, they're leapfrogging it. This isn't financial advice, it's perspective. This is the era of utility, and it's already happening.